Happy Saturday, everyone. You're a daisy if you watch. So, here we go again. So, what I'm going to do here is I'm going to read the scenario and offer a little bit of color commentary on it for your education and amusement. So, the title of this first one is I co-signed a vehicle with my ex-boyfriend, and he's been missing payments. A year ago, I co-signed a lease with my current ex-boyfriend. Huh. Wouldn't that just be an ex-boyfriend if he's currently your ex-boyfriend? Wouldn't... okay, anyway. Because his credit was too low to take out the vehicle on his own. Last month, I received a letter saying that a payment is late, and this month I received the same letter. I have been reaching out to him, and he's always ignoring and telling me he will take care of it, but it seems like he doesn't have it under control. Yeah, it seems like it. Will this affect my credit if I ever want to go buy a new car under my name? If anyone could help me with this, it is really stressing me out since my credit was 800 before, and it's now 690 because of his missed payments. Any advice would help. Well, first point here is that it is already affecting the OP's credit by 110 points, roughly, based on the numbers that they've provided. So, unfortunately, yes, it will affect their credit, and already is. And if they go to buy a new car under their name and they see that your name's already on a car loan that is delinquent, because if they do a hard pull on your credit, they will almost certainly see that. Yes, it will. So my advice, unfortunately, well, the best advice would be don't ever co-sign with anybody that is not either your spouse or your child. Certainly not a boyfriend or girlfriend like this. But I would even say, probably not brothers, sisters, cousins, whatever either. Because when you co-sign on something, you're basically saying, hey, oh, nice. Welcome to the stream, buddy. So if you do that, you're basically saying, hey, I'm promising to pay like in a co-equal way with this other person, hence a co-signer. So don't do that. Now, the only exception maybe being if you are fully prepared to and can afford to make the payment yourself if they fail to. And that's really the only option I can see where this person has to, salvage what's left of their credit is start paying the payment yourself, essentially, which sucks because this is an ex-boyfriend. So every time they write that check, they have to be reminded of the failed relationship. It doesn't sound like it was necessarily on great terms since the person is dodging them, etc. Anyway, so unfortunately, that may be an expensive lesson, but we always say all tuition is expensive. Why, hello to the chat. So, let's see what other fun scenarios we got here. Oh, looks like a bit of a budgeting situation we've got here. This ought to be fun. Yeah, so on the last one, basically the scenario was co-signed with a boyfriend who is now the ex-boyfriend on a car he stopped paying. Yeah, you don't want to do that, ladies and gentlemen. Bad idea. Unless, of course, you're 100% willing to just pay it yourself. But based on the surprise Pikachu face I'm imagining, I don't think that was the case for that person. So, this one. How to make $500 last 2 weeks. Am I being unrealistic? Hey, folks. I have a spending problem. Well, they say the first step in solving a problem is acknowledging that you have one. So, that's good. And I'm working on paying off my debts. My current budget lets me pay off $1,000 a month on credit cards and leaves me with between $500 and $600 for all miscellaneous spending gas, groceries, dates, drinks, etc. I frequently seem to spend this too fast, though, and have to spend some on my card to get food and gas the second week. I feel really broke. I rarely get to go out or eat out on this budget, and things like getting an oil change are legitimately stressful. Am I budgeting too little? I spend $50 a week on gas, $60 to $70 groceries, too much on Uber Eats, $50 to $100 a week, then $50 a week on Amazon protein powder, gym equipment. All right, nobody needs $50 a week worth of protein powder. Okay, I'm gonna call just the cap right there. Like unless you're buying some really overpriced protein powder. Like I used to bodybuild. I know how much. Like yes, protein powder is kind of expensive, but unless like all of your meals are coming from protein powder, which I hope they're not, you don't need to spend that much on it. Yeah, I mean, because like we're I mean, I could see like 20-25 bucks a week maybe, like if you're using a lot of it and doing like 2 shakes a day or something. I mean, maybe inflation's really hit this hard in the last couple of years and I just didn't realize. I don't know. But 20 a week on vapes, yeah, bad habit, I know. Already breaking my budget. Okay, so there are some things that are a little confusing here. Like they're talking about that they can do 1,000 a month, and then they see it leaves them 500 to 600 for miscellaneous spending. Now, is that a month or is that every 2 weeks? Because the title says every 2 weeks. So it seems like maybe they're talking about 1,000 per month here, but then like a per paycheck kind of thing here. I don't know. But either way, like I think that this person probably needs to cut down on the Uber Eats. Maybe consider getting some cheaper protein powder. And, you know, granted, they say they have a girlfriend here down below in their postscript here. I spend too much on delivery. Sometimes I'm at my girlfriend's. She just wants something quick delivered. Well, you know, you could ask her to pay for it every once in a while, buddy. I'm tired of feeling broke and not paying off my card as much as I should. Any help or advice? So, honestly, in a situation like this, I would see about, you know, getting this person to spend just 1 week, starting from absolute zero, and not spending anything except for like gas and groceries. So no dates. Like if you want to have a date with the girlfriend, you guys stay in and cook and watch a movie on Netflix or whatever. No going out for drinks. Maybe even cut the vaping if you're not so addicted that it seems impossible to do so. And, you know, just literally just bare bones it, go absolute minimum, don't spend on any of the superfluous stuff for just a week. If you can get through just a week and survive, maybe you can then realize like, oh, I don't really need to spend this much on this stuff. And, you know, I think it's like all like if this person is a gym user, they understand putting in the reps to attain the discipline to do the thing and get better at it over time. So I think maybe that would be a good approach for this person in this situation. Because honestly, like, yeah, some of this stuff does seem a little bit excessive. But what I don't like is that they don't really tell us, like, how old they are, what their income level is, how much total credit card debt they're actually dealing with. They just talk about trying to make the $500 to $600 last 2 weeks. Yeah, I don't know. Not enough info about the overall situation to really grasp where this person is at, unfortunately. And that's something that people, you know, it's a mistake a lot of people make when they post these things for advice. They don't really give you a lot of like the critical stuff. They want to add stuff about like how they feel and all that, but it's like you could tell us a little bit more of the facts that are actually relevant, and there might be something in there where people could help them out a little bit more. But I digress. Now this person is looking to finance a $5,000 car. So their current car is a 260K Champion of a car. Okay, so that's probably the mileage. And it's got inspection flaws that won't be economical to fix. Registration ends in October. So understandable situation there. For those of you that maybe aren't in an area that this is a concern, basically cities that have too much like air pollution and whatnot, you have to pass like an emissions test basically to renew your registration. I'm assuming that's the inspection flaw they're talking about. Maybe there's some other inspection required in the state they're in. But either way, yeah, if you've got those kind of problems, won't pass whatever you need to renew your registration, that can be a real pain in the butt. They should be using the money to buy MPW stock. Yeah, I mean, I like me some MPW stock. Some people would argue I have a little bit too much MPW stock, but I mean, can you really ever have too much of an undervalued stock? Let's see. Gonna need it as soon as October. Income $300 a week. Would I be able to finance a $5,000 car without down payments? Ooh, heavy credit utilization. So they're worried about a down payment. Now, I've only ever had to finance one car. It's paid off now, and didn't require a down payment because my credit was good. I would maybe, if I was this dude, I would consider, like, depending on how much that 70% utilization is in terms of credit card debt, I would say pay off all of that if you can by October. And, you know, if you absolutely have to finance a car, if you can't come up with enough cash for a, $5,000 car, at least then your credit score will have gone up from you lowering your utilization, and you can get a more favorable, a more favorable rate on your car loan. But bad boy on those credit cards. Don't do that. Don't carry a balance, ladies and gentlemen. That's a death spiral for your finances. Let's see. Do you lose motivation at a certain point? Oh. So, before I go on to that, we can talk about MPW for just a minute, okay? So, is the short interest still pretty high? I haven't looked at the short interest lately on MPW. It was high, last time I checked, of course, like around 20%. A 1,000 shares, huh? Well, you're in it about as deep as I am then. Yeah, that's pretty crazy, I'd say it's probably a $14 or $15 stock just based on the balance sheet. But against its own historical valuations, you could argue it's like a high teens, low 20s type stock, like in terms of what it should be trading at, because a lot of other REITs actually trade at a pretty good premium on their net asset value. And if you look at like multiples of their FFO, their average yield on cost and things like that, yeah. So let's talk about this guy that's lost motivation. I used to be a hard worker. Now, as house is fully paid off, I have Roth IRA with 8,200, two 401ks that have 1,700 in high yield savings. 34 years old. Worked so hard paying off the house fast, and now that I've paid off a 30-year mortgage in 6 years, now I feel like I lost motivation. Like a person can die anytime. Why work hard and save for retirement when I can die when I'm 40? Also, I have nothing I want to buy or need except to save about 9,000 for tooth implants and add more to the Roth IRA. But I don't feel the same as before. How to get my mind back on track? Well, so first thing I'd ask is like, what the heck would you? I mean, so if they got the loan 6 years ago because they just got done paying it off, mortgage rates were like what, like 3% or something? That's a terrible ROI. So paying off your fixed mortgage early, if it's like 2.5, 3, even 4%, that's an absolute abysmal place to put your money. Like, let's say, he had like a $300 or $300,000 loan. Imagine how much that would have grown if he would have put it into good, solid investments instead and made like even the market return of like 9 or 10%. Although over the last 6 years, it actually would have been a lot higher than that. Granted, a lot of that is price movement and, in my estimation, overvaluation. Yeah, exactly. This dude would have, he'd still have a house payment, right? But he would probably have like, I don't know, 600 grand in an account if he had done that instead. Like, I wouldn't mind having a low interest house payment still at 34 like this guy if I had 600 grand in an investment account. That would be a pretty sweet situation to be in. But instead, he has a paid off house but like kind of feels broke and saved himself what, 3% a year on interest. Oh boy. I mean, I feel like that was a huge blunder. Probably, I mean, and look 20 to 30 years down the line, he probably cost himself like a couple $1 million, honestly. Right. Yeah, exactly. And here's the thing. Your income goes up. Like if it's a fixed mortgage, your income goes up, right? Even if it's just a small increase, but your payment stays the same. Unlike rent, which is going to have, periodically, it's going to be increased by whoever, owns the property you're renting, right? This dude would be in such great shape if he had just not. I mean, I said, what if it was a $300,000 mortgage? I don't know what his mortgage, like what the size of the loan was, but I'm just saying, like, regardless of what it was, he would probably have multiple six figures, if we look at what average, home prices have been in the last few years. He would have multiple six figures in investment accounts right now and would probably feel freaking amazing about it. And here's the thing: if he needed the tooth implants or whatever, he could, he would probably have the cash in hand for it, to be honest, because he would have more than maxed out his retirement accounts, in all likelihood, with the amount that he had to put toward that mortgage to pay it off. Yeah, I mean, I feel really bad. I feel like this guy probably subscribes to Dave Ramsey and is like, debt's bad, even if it's only 3%, pay it off as fast as possible. But, oh boy, that's rough. That's rough. So, look, there's nothing wrong with having equity, but like with the way home prices have gone up in the last few years, he'd probably have like 40 to 50% equity in the thing by now too. Just making the regular payments, letting the price, appreciate like normal. Like, I mean, the dude has a ton of equity now, right? But here's the thing: if he uses that equity for anything, it's going to be now at a higher interest rate than what his mortgage was, because interest rates are much higher than they were 6 years ago. So basically, like, yes, he technically increased his net worth, but he killed his liquidity. Okay, if everything that he had over and above his, retirement accounts had been put into like a regular brokerage account, he would have so many options of what he could do. Like, he could cash some investments out to, pay for the things like this tooth thing. He could take a margin loan. If he had any dividend paying investments, they could pay the interest for him and he wouldn't even feel it. There's a lot of different things you could do with that extra money being in an investment account instead of just in equity in a paid off house, with interest rates being what they are today, right? Yeah. Completely the non-optimal move. So, I really, like, I don't like debt either, okay? And I'm not necessarily an expert in the Dave Ramsey plan, but I do know that they advocate for paying off everything except your house, and then putting 15% into retirement or something along those lines. But they also recommend like 15-year mortgages and stuff, and it's, yeah. There's some stuff that's not like, it's not exactly like the numerically optimal thing. Although I do acknowledge that, the reason it works for so many people, you do need, like, some people really do need like that really, really rigid black and white, this is good and this is bad kind of discipline and rule set to be able to operate. Like, there's a lot of people that there can't really be any wiggle room or gray area. There's just some people that are not good. They're not good at, like, I guess, like, taking things on a case by case basis and actually making good decisions. They, it's like, if you can't put it in either the good pile or the bad pile, and it's not that simple, they'll more often than not just make the wrong decision. People are really heavily into, like, their feelings and things like that, which is why. So there's the good old debate of, like, the snowball versus the avalanche when it comes to paying off balances on debts that you owe. Snowball is lowest balance to highest, and avalanche is highest interest rate to lowest, regardless of balance size. And the Ramsey plan advocates the snowball because the small victories along the way boosts your, like, motivation, because it feels like a psychological victory, right? Like, oh, I paid off this balance, and those little wins along the way are what keep you motivated. Which, I think for a lot of people that definitely makes sense. Like, imagine if you had like 11 different credit cards and like a car loan and like, a couple personal loans. Like, imagine you're in that kind of a scenario. You need those wins along the way probably to get you through. So, yeah, this guy, I understand why he's like, imagine that. Imagine how drained he probably feels throwing everything at that house and then just feeling like, okay, now what? You want me to judge the financial decisions of my viewers? Yeah, I could be a Caleb Hammer copycat every once in a while if you want. Yeah, I know. Oh my gosh. Imagine selling really good investments that give you market matching or market beating returns to pay off a 3% mortgage. What a freaking clown move. But it is it's like a cult like mentality though, right? It's like, if you don't follow to the letter like exactly what they prescribe, you're automatically wrong. And it's like, I mean, I think you do have to I think you do have to take things on a little bit more of a case by case basis. Although there are some things that are like always like mathematically incorrect to the point that it's like never do that. Like payday loans, I have yet to see a situation in which it seemed like a good idea for somebody to take out a payday loan. Good for him. Good for him. But Dave also thinks it's bad to use any leverage for investment real estate. And it's like, I mean, again, if we're talking about 3% interest rates like 4 or 5 years ago or whatever, and you're getting like a good deal where you can add value, grow the rent and everything, and have a bunch of equity, like dude. So leverage is, yes, like there is such a thing as too much leverage, right? But if it's properly managed and the level of risk is properly managed, you'll be fine, right? So Dave Ramsey's background with real estate was that he was very I get the impression that he kind of played on the edge with like these short-term loans, and it was sort of like a game of musical chairs, and the music stopped playing and he couldn't make things add up, and the bank called in the notes, and that was all she wrote. I think it was like during the 80s or something, and things were kind of crazy during the 80s. And I think he was like flipping properties or something like that. But either way, debt got him into trouble, ergo debt bad. That's kind of what it is. And hey, like I don't carry any balances on anything. I don't have any car loans, personal loans, etc. So like I'm with you. I'm with him 100% of the way there. Okay. Question for those who went to grad school from impoverished backgrounds. So they're asking about how to manage with the loans, etc., etc. So I'm not going to read this whole thing because it's like a wall of text. But what I will say is that in general, grad schools that you have to like take out a huge amount of debt to go to, the ROI doesn't justify it, in my opinion, right? Because you have to think, okay, it costs this much. I have to take out loans to cover it. They accrue interest. I take myself more or less out of the workforce for those 2 years, so you have that opportunity cost, right? So is that graduate degree going to get you more money than an extra 2 years of work experience when you account for how deeply in debt you also have to go and how much that interest on that debt's going to burden you for the next, say, decade, right? How often, if you take those things into account, are you better off taking out debt for grad school? I would say in most cases, unless we're going to be a physician or an attorney or something, or maybe a dentist, something like that, or, I'm really dubious on whether or not that's actually going to end up working out in your favor. And this person specifically mentions they're from an impoverished background. So a lot of people that come from impoverished backgrounds but do well academically and whatnot, they what I like to call the academia industrial complex. They kind of get stuck into this thing of go on to the next degree, go on to the next degree, go on to the next. Yep, yeah, me too. Yeah, definitely the earlier you can start, the better. But I definitely, I've got people on here in their 40s, even older in a lot of cases, that maybe didn't get started super early. But the thing is, you're always, the best time to do something, as I say, is yesterday. Second best time is today, right? Nobody's got a time machine. The woulda, coulda, shouldas, it's better not to dwell on them too much, but to more or less focus forward thinking, make the right moves in the present and into the future, right? So, with this individual, I actually replied on this with some some recommendations, right? So for a lot of subjects where it's beneficial to have a graduate degree, you can attend as something like a research assistant or a teaching assistant and have your schooling paid for and actually receive like a small consideration for your living expenses from the school and not come out of it with a mountain of debt. Their major, which is psychology, is one of those where I've seen that happen where yes, there is some extra work helping out either with research or with teaching, but that stuff looks good on a resume because you're getting some experience working under that professor or whatever in some capacity. You may get credited on different like academic papers they publish, etc. So there's some benefits there too, but taking out a bunch of loans to go to grad school, I would pump the brakes on that in most cases, right? Now, if you're going to med school and you're going to be a physician or something like that, you're going to be like a cardiac surgeon or a neurosurgeon or something. Okay, you can probably dig yourself out of that mountain, but there's a lot of careers where that's not really so much the case, right? This was a fun one. This person was asking how they know how much dividends they earned for their tax. So everybody on the channel should know about this, and I responded to this fellow. Pretty much every brokerage, I mean, all the ones I've used, I've got a few different accounts, but pretty much all of them, you go to the tax forms tab and you just pull up the PDF of your 1099 div, and you're good to go. Just send those to your CPA. So Peachy, all right. Good comment. So Peachy asks, 19, 30K invested in REITs like ABR and MPW, as well as diversified in dividend ETFs like SCHD, and a good amount of CVS, I assume the pharmacy CVS, their stock. And additionally 20K in bonds. Is it I bonds specifically? Too conservative? Thoughts? Maybe a little too concentrated, if anything. Like REITs, I mean, I like a good undervalued REIT like MPW, right? But I mean, we're talking about 30K, and you're saying those are some of your top holdings. You're probably not going to see like a ridiculous amount of growth from them. MPW will probably move back to its like actual intrinsic value at some point in the mid-teens to low 20s. That's kind of like the range you could put on that depending on how you model its value. I'm curious about the ETFs you've got other than SCHD. I mean, SCHD is, I think, pretty heavily weighted into like things like consumer staples. So I don't think that there's anything wrong with having good consumer staples. I mean, Warren Buffett invested a ton of money into Coca-Cola in the 1980s when it was like, I think it was like even a 30 PE, like even back then. And he's done fabulously on it, and consumer staples are considered conservative. Well, I agree with your focus on value. Actually, we can move over to a little bit of stock stuff if you want. So, So why don't we look at CVS, since that's someone actually asked me to do CVS recently. I haven't looked too much at CVS. I own their main competitor, Walgreens. Now, I will say, CVS, I'm surprised at this amount of revenue growth. Like, I'm actually kind of shocked. I haven't looked at it really very closely, so in the past, so like, my goodness, who knew that they were putting up this much revenue growth? Certainly not me. I'm sure other people have known, though. That's pretty impressive. So their EPS was growing at a pretty good clip. Big drop in EPS, but not as much of a drop in free cash flow. So they must have had some kind of paper expense hit their books in 2022. Yeah, so I really like cash flow powerhouses, Peachy. So, and here's the thing, I don't know any analyst estimates or anything for CVS. Whoa. Am I seeing the correct price? They're down to $69.60. Oh. All right, cool. I got logged out of my account. That's nice. Love it when that happens. So, there we go. So, my goodness. So I don't know what a good growth rate. Actually, I hate deducting the tangible book value off of a company like CVS or Walgreens, because a lot of that's probably capital lease obligations. What do you think is a good growth rate for CVS in terms of, like, what do you think the CAGR will be for their free cash flow over the next 10 years? I'm sure you've looked at it a lot more than I have. I think 12.8 is probably too high for the next 10 years. They've done it over the last 10, but generally speaking, as it goes higher and higher, the rate at which they can grow it probably slows down at some point. Wow, 8 to 9%. Okay, I mean, I'll go with something more conservative. We'll call it 7.5. I mean, if they're growing their free cash flow at 7.5% over the next 10 years, really, I mean, this almost seems too high. Like, there's got to be something that we're missing. Is their current free cash flow especially high? Yeah, the current free cash flow in the DCF calculator is a little bit higher than what they've had over the last 3 years. So here's what we'll do. We'll call it. We'll say that they're growing from 1050. This would be a pretty normal level, but yeah, even still, like, man. Like, even if I'm beating this thing up, you're making me want to do more research on this. So I have some money in, gosh, I think I've got like 3 BDCs in my portfolio. How much of a return would we get on this thing? Yeah, okay. So, I mean, this is going to warrant a little bit more research, but if you think the free cash flow is going to grow at 7.5% for the next 10 years and slow down to 4% in the following, starting from a $10.50 free cash flow, you could expect a 22% return roughly at today's prices on CVS. That's insane. That's insane. But these assumptions would have to be correct again for that to happen, right? And so definitely need to do a little bit more digging on them for that, because I haven't read any analyst estimates or anything like that for them. So I have ARCC as well. And I haven't heard of HTGC, whatever. Let's see. So I'm just curious, like, have they dropped recently or something? Okay. Because, yeah, last time I remember looking at CVS, I felt like they were in the 80s or something. And so I was like, eh. But, yeah, I mean, their PE looks high, but their free cash flow is so much higher than their earnings right now. And again, like, when it comes to the tangible book on both CVS and Walgreens, I'm pretty sure they both lease basically all of their locations, and I can't penalize a stock price just because they have, leases for the next, 8, 9, 10 years, whatever it is, on all their locations. It's like, well, yeah, but those are more like I feel like those are more like a monthly expense than a debt, but I don't know. That's the accounting rules, so I don't know. I think that one was recently changed too in the last few years as well, but that's my question though. I mean, how much of that's debt and how much of that's capital leases? Okay, long-term debt. $67.2. Does this site show us how much of that's leases? You don't happen to know how much of their long-term liabilities are capital lease obligations, do you? A lot of goodwill, probably from acquisitions. Yeah. So, Peachy, what I would do if I was you, especially since you already have the stock, might be worth maybe pull up the most recent 10K and take a look at. I mean, they probably just hit Control F on your keyboard and type in lease, and you may find it. Okay. I mean, that's what I'll probably end up doing because if a lot of those liabilities end up being capital lease obligations, I'm not really considering that to be like a big mark against them. But if it's a lot of like cyclical debt that they'll have to refinance or something along those lines, then it's like, well, how soon do they have to refinance it? And that kind of thing, that becomes a concern, right? What kind of interest rate will they have to refinance it at? And, obviously with interest rates being higher, that can be a bit of a concern. But if a lot of it is capital lease obligations, those usually have built-in rent escalators, so we know how much their rent will go up each year. And I know Walgreens leases a lot of their buildings from Realty Income, and Realty Income only puts in like a 1% rent escalator. So when people want to say, well, look at those liabilities for Walgreens, it's like, well, hey, how much of that's leases? And those leases, they have, really, really good terms for Walgreens, I think. 1% escalator. That's one of the reasons I actually don't buy a lot of well, I don't buy REITs a lot of the time that are in like the sort of retail space because the rent escalators are kind of low. I mean, granted, they have great occupancy, but something like MPW, which or even Vici, which has a CPI-based rent escalator, I feel like that's a better deal for the property owner. And if I own shares of the property owner, I want the rent escalator to be based on something other than just an arbitrary like 1 or 1.5%. Something like the CPI means, hey, at least our funds from operations are growing with inflation, and theoretically the distributions paid to the shareholders are growing that way too. But yeah, you've definitely got my interest peaked in CVS. So, I mean, heck, I might sometime in the coming week or so, maybe I'll take a look at some of the specifics and throw up a video on them. I might even sell some puts or something. This looks very attractive. I know it might be a little weird if I have both CVS and Walgreens, but I mean, healthcare is not going away. It's like, I think about a sixth of U.S. GDP goes to healthcare, so pretty decent bet that that's going to go up as the boomers continue to retire and age. So yeah. I feel like you don't really necessarily go broke putting your money into health companies that provide essential healthcare services. You know what I mean? Okay, so yeah, like maybe like just under a third of it is lease liabilities. Yeah, the dividend is nice on Walgreens, but they've been getting slammed by a lot of different things lately. The opioid lawsuit thing, they had to pay like $6 billion. California going to war with them over the reproductive stuff, which that's more of just like political grandstanding and scapegoating. Like the fact that some states are trying to like outlaw certain types of pills and stuff, that's not Walgreens' job to, fight those battles. It's their job to just offer whatever medications are cleared and legal to sell in whatever state that they're selling them in, Yeah. So, that's kind of the take there. So, all in all, I have a pretty good time going through these different posts on the personal finance thing. I mean, I could do like a Wall Street bets thing as well if people wanted to see that, or like there's like a little bit less interesting investing subreddit also. If you guys find reading those and reacting to them at any point fun. Okay, so Peachy's in. Okay, I'll probably do another live tomorrow at some point, so maybe we should we could do it then. Maybe I'll do a little browsing before then and find some fun posts. But yeah, I mean, Wall Street Bets is always good for some material. But yeah, man. Yeah, I might not be able to ignore CVS at this price. Is that one of the banks? PACW? PacWest Bancorp, yeah. Was this one of those ones that got caught up in the whole thing? Yep. This chart reminds me a lot of First Republic. So no, I haven't. I haven't done any kind of thing on PacWest. So they're at 723. I mean, I feel like the balance sheet stuff you get on third-party sites tends to be a little bit. They don't have too much total assets and total liability. Hey, at least they total assets, total liabilities. Perfect. So shareholders' equity. So book value of like right around 4 billion, and market cap of, Okay, so this probably is not up to date. This is probably not up to date. Yeah, this is most recently 2022. So, I mean, if this was still accurate, it would look undervalued for a bank, but I sense that they may have had depositors flee and have had to pay a bunch out and maybe liquidate some things. So, yeah. Oh, yeah, I mean, that's the thing. I will say, like, almost certainly this really, really super low point right here was almost definitely an overreaction at that point. But at the same time, I'll just say this. It's super, super, super hard to be the person saying, yeah, everybody else sold this thing off massively to the tune of like 80-90%. I'm gonna buy it because I think all those other people are wrong. So there's a certain like sense of safety with the herd that, you know, not just people but like all kinds of different animals have, where it's like you want to be in the middle of it. You don't want to be an outlier doing the thing that everybody else isn't doing because it feels so unsafe. Emotionally, it's extremely hard to be the one loading up right here, okay, even if it's correct. Now, I know Michael Burry, like, that's kind of his thing, being contrarian. You know, I will tell you guys, like, so when it comes to Meta, okay, so I was selling puts right here. Like, literally. Now, selling puts means if it goes lower, you know, to your strike price or below, you have given somebody else the right to place 100 shares in your account. Selling puts is generally viewed as what they call a bullish move, essentially. When Meta was right here in November, everybody hated Meta, and everything you could find on Meta, generally speaking, was talking about how horrible they were. Okay? Like, now I knew, based on their financials, all right, that they were quite good. You know, they are a money machine. I'm curious what this will come up with. So, yeah, I mean, what you would have come up with here would have been roughly this same number back when it was like, you know, $90 a share, right? But everybody else was saying how bad it was, how much they hated Zuckerberg's legs. Oh, yeah. As soon as Jim Cramer was crying, saying that he was wrong to recommend it, you know, like that's your indication right there that it was actually probably smart to hold on to it. But, yeah. I know that, like, you have to have, like, a ton of, like, emotional fortitude, conviction, discipline, and understand what you're actually paying for when you buy a stock. Like, if you, like, imagine you bought it here when it was $378, like, how hard it would be to watch it crash to here. But the people who paid this amount, this is the problem with them. They only knew that they bought it because everybody was saying good things about it because it had recently been going up. So the inverse Kramer ETF, I've heard, does pretty well. But yeah, there are so many individual active market participants that only buy things because they've been going up recently and everybody says good things about them, right? So yeah, the people who were buying Meta in this area, it was probably mainly for those reasons. Because I thought, the valuation honestly was not horrible compared to some other companies out there, but still pretty stretched. Even in like the mid 200s. And so like I was, not necessarily ignoring it, but like really kind of hoping for a pullback here. I certainly wasn't ignoring it down here. Now, I feel horrible that I didn't get assigned shares of Meta when it was, in the 90s, right? I kept selling puts actually on the way up. When it was like December, I think was the last time I did. When it was like sub 120, basically, was when I was interested. Now, granted, I realize it's worth a lot more than that, but that's the point at which I felt it was like a no-brainer. When something's a no-brainer, yes, that's when I like to put the most chips in. And that's why like I went so heavily on MPW. It's like it was such a no-brainer for me. Now, even something that looks like a no-brainer, you can still be wrong, right? The worst can still happen. But if you pay really close attention to valuation and you look at what kind of cash flow they can produce, what their balance sheet looks like, etc., and you make considered decisions when they look undervalued based on their financials, and give yourself a high discount rate, a high margin of safety, you will more often than not do reasonably well. Because a lot of my investments, like, hey, even if I'm wrong and I don't get, like if I had put in a bunch of assumptions that told me, hey, this looks like it could be like a 15% annual return. Well, even if I'm wrong, like really wrong, it could still end up being like a 9% return. Oh no. Yeah. It's like, and then the ones where you're right, or the ones where you're wrong and it's actually better than you thought, more than make up for that. Hopefully. That's the wish of every value investor, that you're not wrong too terribly often to the downside where it does worse than what you think. But when you are, because of your margin of safety, etc., you still do pretty well. I mean, you'll pretty rarely be exactly dead on, right? Like, you're not gonna put in a bunch of assumptions, estimate a 15% return, and get exactly 15% over the next 10 years. That's not gonna happen. But certainly, you could end up with 14%, you could end up with 16%. Sometimes you'll be pretty darn wrong, though, and you'll end up, with like a 8 or 9%, right? But also, hopefully, sometimes you'll underestimate what a company can do and you'll get 20%, right? That's the hope. And if you're Warren Buffett, well, you just do 20% a year for like 100 years and, you become a legend. Yeah, so with PacWest, buddy, yeah, what I would do, so with banks, I would say you want to understand the balance sheet. That's the thing you want to focus most of your attention on, okay? Because the thing that caused all these bank failures was there was softness in the balance sheet, right? They had, Silicon Valley specifically, they had a lot of money tied up in long-term bonds with very low interest. And the value of those plummeted, right? So they actually, but the way they categorized them on the balance sheet, I think, was something like they were planning on holding them to maturity. So the value they reflected on their balance sheet wasn't actually reflective of what they could really sell them for, because there's another category for whatchamacallem, and I wonder if it shows on this. Yeah, we would have to pull up the real balance sheet to show it, but there's another thing that where it's like they have securities held for sale, which is stuff that they're planning on basically selling off, assets they're planning on selling off in the near future. And those will be like, kind of like what they expect to be the cash value, right? But the stuff that they plan on holding to maturity, they'll leave the face value on there. And with a bond, there is like, if you take out, if you were to buy like a $1,000 U.S. Treasury bond, for example, you would get your yield on it every year. If it was a 10-year bond, you would get your yield every single year on it. And then at the end of the 10 years, you get your principal back, right? So theoretically, if you're holding it the entire 10 years, it's still worth that $1,000 that you paid for it originally, plus, whatever. But like, if the interest rate you got on it was like 2% and interest rates go up to 6% and you had to sell it all of a sudden, nobody's going to pay the original $1,000 for it, because they could just buy one directly from the Treasury for 6% today, if that makes sense, right? Or another way to say it is that price and yield are inversely correlated. So even if you originally paid $1,000 for the bond and will get that $1,000 back at the end of the 10 years, if you've still got 8 years left on it and the interest rate's super low, nobody's going to give you that original amount for it. It wouldn't make sense. So what happens if a bunch of depositors, so deposits are liabilities, right? So deposits on a bank's balance sheet, those show up as a liability. That's money that they owe to people who deposit money in the bank. If more people go to withdraw money than what they have in terms of cash and equivalents, well, they have to start selling some of their other stuff. And if they have too much in really, really long-term bonds at low interest rates, and they have to start selling to meet depositor obligations, poof. The FDIC, if they can't, sell fast enough, or they don't have enough that they can sell to cover it all, right? That's a bank run, right? There's too many depositors trying to withdraw at once. The FDIC takes over. Yeah. And so that's why with banks, it's so critical to understand the balance sheet as best you can, and to make sure that they aren't like, yeah, and I would actually pull up the bank's actual balance sheet on their 10K, or their most recent quarterly if they've recently had issues, and understand that. Don't trust the numbers on a third party. A third party site like this is cool for like a quick overview of like the general situation or whatever on a company, but you want to see the actual real thing in black and white on what the company filed with the SEC most recently when it comes to looking at a bank's balance sheet. And it'll have, the categories will be a little bit different and give you a little bit more, I think, detail and insight. So, yeah. But I have Bank of America. And I've also got Key Corp. Now, Key Corp got obliterated in terms of their stock price. I'm down like 40% on this puppy. It's pretty rough. Yeah, that's exactly where you find it. You want to go to their investor relations page, and Yeah, the problem is if they sold that 5 billion just to meet depositor obligations, they probably didn't get the best deal possible on that sale. Wow. So, it has actually literally been an hour already. Doesn't feel like it when we start talking about stocks. So the big thing I would look at is, again, the balance sheet. See, like, does it seem like they're pretty flush with cash? Now they're never going to have as much cash as they have, deposits, but look at how that compares to like a more stable bank, like a Bank of America or something like that, and say, hey, what's the ratio they have of cash versus deposits, and does it look like they're in a good spot to cover anybody that needs to pull money out? Because if the cash situation looks really, really thin, even after they've sold a bunch of things and all that stuff, I would be a little bit concerned. But here's some, I guess you could call it, opinion from me. So I got a signed Bank of America, I think, in like the $34 range. Honestly, I've been considering averaging down, trying to maybe double my position a bit. Because, all right, Bank of America, they're not going anywhere. They're basically too big to fail, right? Yeah, I do also have shares in KeyCorp. And with KeyCorp, I think, to an extent, I probably took opinions of others that I had read and heard a little bit too more into consideration than I normally would. And I don't really like my cost basis on it. I don't think that the drop in price is necessarily justified to as low as they are now, but I think I slightly overpaid for KeyCorp. But I don't think that like $9.43 a share or whatever is necessarily the correct price for KeyCorp either. But yeah, Bank of America, I would say, is almost certainly undervalued at today's prices. It was like a sector thing. Like, just banks just took a giant hit regardless of the quality, regardless of the actual value at play. So yeah, I'm definitely considering averaging down Bank of America a bit. It's still, I think it's still a Warren Buffett favorite as well. And yeah, they've got the pretty solid cash position. I just don't see anything happening to them. And hey, they do a lot of buybacks. They have a nice dividend. And I think their price to book is at a recent historical low for them. Yeah. Like, yeah, it's a boring thing to put your money into. But, boring's fine if it's profitable, right? Sometimes good investing is boring investing, as they say. So, oh man, U.S. banks taking a real hit. Wow. So, funny thing, I actually was pretty interested in it last fall and was actually selling puts when it was in like the low 40s to high 30s range. So, yeah, maybe I should consider this one too. Although I don't really want a ton of banks, Yeah, I think I might just average down on my Bank of America since I already got assigned those shares and kind of have made that decision to hold on to them as a position rather than go into yet another bank. What I really want to do is look into some deals in utilities, electric companies, water companies, that kind of thing. If you can get those cheap, like they're not going to be like absolute growth monsters, but if you, is that Teladoc, Peachy? So all right, they had these highs of, wow, they had a high of, imagine getting into Teladoc at $293 and seeing it sit here at $23. So let's look at their income statement. So, okay. Is the revenue growth impressive? Yes. But they don't make money. That's the problem with Teladoc. I just, yeah, it's weird because like they're showing 10 cents of free cash flow when they had, and I don't know how this is possible, negative $84 per share in earnings. I don't know if that's a glitch or what, but even still, like, I don't see any profit happening here either, And I don't see much cash coming in. Yeah, it's troubling when you see these kind of numbers. It's like they're growing the top line, but the problem is they're not really showing the ability to translate that into a return for their shareholders, They have good gross margins, but it seems like, I don't know, like honestly, I'd need to see something change and start to go in the right direction in some of these more bottom line numbers before I'd be interested. So, okay, Peachy, I'm glad that you made that argument. So you're saying they're one of the only major telehealth companies and have been around quite a while. I don't see a future without a lot of telehealth. So that statement could be 100% true, and they could be the best right now, and 10 years in the future they could still be the best. But that could still not mean, they may still actually not be a good investment at today's price, even if, one, telehealth is the future, and two, Teladoc is the leader in that area. I know that seems like super counterintuitive from what like anybody else will say, but what ultimately you're buying, right? What this $23.74 per share is buying is the sum of all of the future earnings and cash flow and the future balance sheet of this company. So a good example for this is Tesla. Okay. Do I believe that the future of automobiles is probably moving in the electric vehicle direction in a lot of ways? Yes, 100%. I think electric vehicles are, I don't think there's going to be now a future automobile industry that doesn't have electric vehicles. So yes, electric vehicles are a thing. They are here to stay, and they're probably going to grow, right? They're going to be huge. 2, Tesla is the biggest. Yes, exactly. Tesla is going to be the leader in that space. They have been. They've got the history. They've got the technology and everything. They've got the batteries and all that. They've got the gigafactories. They're going to be the leader in that space more than likely, and that space is the future. But as you just pointed out, and you've just sort of finished my argument for me, Tesla is overvalued. So, and we can only figure that out because we actually have now earnings and free cash flow to like do a DCF model and whatnot to be able to say, Tesla would have to grow their profits to some absurd amount, more than any other auto manufacturer ever, and they would have to sell more cars than like Toyota and like a bunch of the other automakers. Toyota's the biggest, and be more profitable, etc. So, and the other car makers, they're gonna have electric vehicles of their own. But so Toyota stock. So Toyota sells more cars than any other car company in the world, right? They've got a market cap of $250 billion. This is the biggest car company in the world currently. All right? $250 billion market cap. Tesla, which is the biggest EV company, but they don't sell the most cars in the world. They don't sell anywhere near what Toyota sells in terms of sales volume. Market cap, $804 billion. Why are they worth more than 3 times the amount of the company that's already become the biggest automaker in the world? Even if they will be the biggest in the world in the future, is it worth paying more than 3 times as much of a valuation for them as the current biggest? In what world does that make sense? And there's a similar argument to be made when it comes to like AMD and Intel, for example, right? And honestly, I just don't like automotive stocks to begin with. I know a little bit too much about how the sausage is made, and I just don't find them to be. I mean, they can be good businesses and whatnot, but the degree, like how cheap I would want to get them is ridiculous. Like Tesla, I start to become interested if it hits like $90 a share. But yeah, so all those things I said about Tesla, about how great they are, how they're a leader in the electric vehicle space, which is definitely going to be here in the future, and they're going to be number one, and they have the most history. That still doesn't make them a good investment necessarily, because it depends what you pay. With Teladoc, I believe, that you've got a solid point that, yes, telemedicine is probably going to be here to stay. There's a future in that space, and they may be an innovator and a leader in that space. But we don't yet know how profitable they will be able to be. They haven't demonstrated that profitability yet. And so I have a hard time knowing if, the current price is a good price to pay, or heck, maybe it was even a good deal, depending on how much they grow, back when it was almost $300. I don't know. And if it's too difficult for me to really be able to figure out the answer to that question, I'll pass, because there's other stocks I can figure out. That's basically that's kind of the long and short ramble on Teladoc. We call her Crashy Wood. So, guys, it's been like an hour 20, so I'm gonna call it here. This is one of my longest live streams ever. It has been real. It's been a good time. Hope you're all having a fantastic weekend. So, Peachy, I'll sign off with one last answer because that's a good question. So, when is it okay to be speculative? So, I got into Palantir at a cost basis of $6.22. It was a 0.5% of the portfolio ish. And this was after like 8 or 9 quarters in a row of free cash flow, and it looked as though they were just about to turn the corner and become GAAP accounting profitable. So, but I still consider it speculative because for that to be worth what I paid at $6.22, they still have to grow that free cash flow and that earnings a lot. But the fact is, they've already proven that they can achieve, high growth in the business, generally speaking, and now they've proven they can turn a profit. And so when the stock got cheap after they had proven those things, I was willing to speculate a little bit and get some Palantir. I still, even though it went up over 130% for me at one point, I still consider it speculative. Just because the stock went up doesn't mean it was a good investment, right? Because I don't know what it'll be 10 years from now, and I don't know if they'll still be profitable, if they will have grown their profit as much as I need them to for it to have been a worthwhile investment. I won't know the answer. Now, if it had been just a trade that I was doing based on charts or something, then it would have been a good trade to buy it then and, potentially sell it now. But I don't trade. I invest. So we'll know in a few years if that was a good decision or not. But yeah, so I think it's okay to speculate with a conservative mindset. Like, recognize that it's a speculative thing, but still apply a process to it. If you can come up with a reasonable scenario that results in adequate free cash flow for you, then okay. But make it a small, in terms of the percentage of your portfolio that it takes up, and make sure it still makes sense using something resembling realistic assumptions. With Teladoc, I don't know what assumptions are going to be reasonable because they haven't even shown that they can turn a profit yet, right? So that's a little bit, that's too difficult for me. Palantir was basically flirting with its all-time lows and was starting to show signs of actual GAAP accounting profitability, as well as already having a track record of positive free cash flow consistently over, I think it was 8 or 9 quarters in a row. So that, to me, was a good case for doing something I felt was speculative. Yeah, so a little bit long-winded. Wish it was a shorter answer, but it's case by case on when it's okay to be speculative. For me, that was when it made sense for me. You would have to determine what the criteria are for when it makes sense for you. But I'd be open to having more conversations like that in the future. If you want to hop into Discord at some point and carry that on, definitely willing to. Otherwise, have a really, really nice night, guys. I will probably hop on again at some point tomorrow.